Hey traders, and welcome to another episode. Today, we'll dive deep into volume trading strategies, combined with smart money concepts that offer safer entries and increased confidence in your trades. We will exactly show you how to use volume as an extra confirmation alongside smart money concepts to execute winning trades. Additionally, we'll dive into the specifics of this strategy, explaining why it's a game changer for traders seeking safer entries and consistent results. Moreover, we will explore the volume divergence patterns, the psychology behind this trading plan, and the price actions associated with it that you might encounter in the market from basic to advanced. But that's not all. We'll break down the key criteria and rules that you need to execute winning trades with this entry method. So traders, if that's something you're interested in, please give this video a thumbs up to show your support and subscribe to our channel if you are new. See you after intro. Welcome back, traders. So, let's get started. Confirmation plays a crucial role in executing winning trades, and we're always looking for additional confirmations in our trades. We don't solely rely on volume strategies for executing trades. However, we can use them to achieve higher quality setups, as they help us to filter out risky entries by adding extra confirmation to trading strategies. When it comes to volume, there are three main types that we can use in our trading plan as additional confirmation for executing entries. The first one is the volume indicator for divergences. This method involves using the volume indicator to identify potential divergences in price action. The second one is the volume profile indicator with smart money concepts. This method combines the volume profile indicator with smart money concepts to analyze market behavior. The third method is identifying higher time frame volume areas, which focuses on identifying volume areas in higher time frames to filter out risky key areas in trading decisions. Now let's dive into the details of each method and see how they can be combined with smart money concepts to provide optimum entries. Starting with the volume indicator, you can add it to your chart by clicking on the Indicator tab and searching for volume. This is the simplest and most commonly used volume indicator among traders. Now, as you can see, the volume indicator has been added to our price chart. Monitoring price volume is essential for evaluating the strength of market moves and gaining insights into predicting upcoming price behaviors, such as market structure shifts and divergences. This indicator is typically represented by vertical green and red bars on the x-axis, showing the volume of orders executed within specific periods. It's important to note that this indicator measures trade volume rather than momentum. Each bar represents the total volume of buy or sell orders filled within the corresponding candle period. Green bars indicate positive volume, suggesting bullish momentum in price, while red bars indicate negative volume, suggesting bearish momentum in price. The color of the bar depends on whether the candle closed above or below its opening price. An increase in volume during an uptrend signals a continuation of the trend, indicating strong buyer interest. Conversely, a decrease in volume during an uptrend suggests waning buyer interest and could signal a temporary pause, a pullback, or a potential shift in market structure. Similarly, an increase in volume during a downtrend indicates a continuation of bearish momentum. On the other hand, decreasing volume in a downtrend suggests weakening seller interest, potentially signaling a pullback or a shift in market structure towards bullish movements. Now let's explore how we can utilize the volume indicator in our analysis to execute winning trades. The volume indicator can offer an early signal of an upcoming trend change. One effective method is to identify divergences between the price action and the volume indicator. Volume indicator divergence occurs when the price continues to move in its primary direction, but the volume indicator shows a noticeable reduction in volume or a movement in the opposite direction. This discrepancy between price movement and volume suggests that the strength behind the current price trend might be weakening, potentially signaling a reversal. In a bullish scenario, divergence occurs when the price continues to rise, but the volume bars start decreasing. This suggests that despite the upward price movement, the buying pressure is decreasing. This pattern indicates a potential bearish divergence and may signal an upcoming price pause or reversal to the downside. Similarly, in a bearish scenario, divergence occurs when the price continues to decline, but the volume bars start decreasing. This suggests that despite the downward price movement, the selling pressure is waning. This pattern indicates a potential bullish divergence and may signal an upcoming price reversal to the upside. Now let's see how we can combine volume indicator divergence with smart money concepts to gain extra confirmation and increase the reliability of our potential trades. Let's imagine that we have a bearish structure on the higher time frame like the one illustrated. We see that the price's general direction is a downtrend, as it has created successive break of structures to the downside and also supply zones attributed to them. In the next step, we expect the price to rise again, reaching our point of interest. Then, we'll zoom into a lower time frame to monitor the price action within this area. What we want to see is for the price to mitigate the point of interest at various levels, and then slow down as it moves upward, entering a consolidation or distribution phase. During this phase, we look for a decrease in volume, indicating a bearish divergence. Next, after the formation of a change of character in a lower time frame, we should identify a spike in volume as increased selling orders enter the market. The volume should continue to rise as the price follows its bearish order flow. The same concept applies in the bullish scenario. Before we move to trade examples and see how we can use volume divergence as an additional confirmation to execute more reliable trades in the market, let's go through some key points to consider when applying this method. A crucial point to consider is that we should use volume indicator divergence as a potential reversal signal when the price reaches unmitigated key supply and demand areas or sweeps liquidity above or below a key area. This approach is more effective than using divergence at random places on the chart or at key levels that have already been mitigated. To properly read the volume indicator without being confused and with ease, all we have to do is when the price reaches a key zone on the chart, we should look for spikes to be formed in the volume indicator, confirming that divergence has occurred. This gives us the confluence we need to use as extra confirmation to place entries. Now let's proceed to the real chart examples and see how we can apply volume confirmation combined with the smart money concept to execute winning trades. Here we have the euro-dollar pair's 1-hour chart displayed on the screen. As you can see, price is in a downtrend and formed a series of break of structures to the downside. Starting from the top, we see that the price broke below this structure with great momentum and inefficiency, marking an unmitigated supply zone at the extreme. Following this, the price experienced a brief pause before resuming its downward movement. It formed 2 successive break of structures and also generated 2 unmitigated supply areas along its downward movement. In the subsequent price action, we witnessed a slowdown in the bearish momentum. After a brief pause and the formation of buy-side liquidity below the swing points, the price retraced upward and entered the most recent unmitigated order block. Following this, it pushed above the zone, triggering the stop losses of sellers. However, it quickly reversed its direction and closed below the order block with an engulfing candle. This sequence of events likely encouraged more traders to enter sell positions and place their stop losses above this zone. Their rationale may have been that since the price had swept the sell-side liquidity above the order block and closed below the supply area with an engulfing candle, consequently, traders anticipated a continuation of the price movement toward the buy-side liquidity below the swing points. However, what occurred was a trap for sellers. The price trapped sellers twice in a row and utilized this supply zone as a strong inducement by triggering the stop losses of traders who had entered short trades from that area. Following this, we see the price triggering the stop losses of sellers from the most recent unmitigated supply area. Subsequently, the price moved higher toward the second unmitigated supply zone, as the price used the lowest unmitigated supply area as a strong inducement and triggered the stop losses of sellers in 2 separate steps. More traders were encouraged to execute short trades from this upper order block. However, contrary to expectations, the price did not respect the second supply zone. Instead, it surged above, sweeping the liquidity associated with the stop losses of sellers from this zone. After filling the only fair value gap above the order block, the price immediately entered the range of the point of interest. So now have a very strong confluence since there's no lingering buy-side liquidity, such as liquidity void of a fair value gap, or liquidity created by the stop losses of sellers remaining in the market. Without any buy-side liquidity to be swept, there's a high probability that the price will move sharply towards the sell-side liquidity, aligning with the dominant direction of the price. In the next step, we need to execute a sell order and enter the market. There are two possible options for placing an entry. We can opt for a single timeframe entry on the current timeframe, or choose a more conservative approach by seeking additional confirmation, such as waiting for multiple reversal patterns, like a change of character in lower time frames, and watching for the volume indicator to signal any potential divergence in the price trend. For this example, I'll use the multi-time frame entry model and look for extra confirmation. To do that, I'm going to zoom into the 15-minute time frame for better monitoring of the price action. Now we have the 15-minute chart on the screen. As you can see, the price created bullish BOSs until it reached the order block, sweeping the liquidity accumulated above it. We see that after filling the upper 1-hour fair value gap, the price reversed direction to the downside and entered into a distribution phase inside the higher timeframe's point of interest. Now, if we look at the volume indicator, we can see that as the price continued its upward movement toward the point of interest, the volume bars started to get smaller and move in the opposite direction. This suggests a bearish divergence and signals an upcoming price pause or reversal to the downside, indicating that despite the upward price movement, the buying pressure is decreasing. So, we have the desired confirmation that we were looking for. In the next step, we should wait for the price to form a change of character or any market structure shift sign. So, let's play out the chart and see what happens next. Now, as you can see, after the mitigation of the point of interest, the price was pushed lower and formed a change of character by closing below the most recent structure. If you look more closely at the volume indicator, you can see that a perfect spike is formed, indicating a bearish divergence. This spike confirms that a bearish divergence is about to happen. So, we have the confluence factors that we were seeking in our analysis. In the next step, I'm going to highlight the order block which is generated by the change of character wave. Subsequently, for executing a sell order, I'm going to set my sell limit order a few pips below the lowest point of the zone. As for the stop loss, I'll position it a few pips above the highest point of the order block. For the take profit, I am targeting the sell side liquidity below the swing point. Now that we have placed our sell limit order, let's see how the market reacts and see if our trade setup plays out successfully. As you can see, price after activating our sell limit order immediately reversed its direction and pushed lower and lower and finally hit the take profit. Now let's see another trading example. Here we have the Bitcoin Tether 1-hour chart on the screen. As you can see, the price is in a strong downtrend and has created several break of structures to the downside. Looking at the upper part of the chart, we see that the price has broken out of this structure with significant inefficiency, leading to the formation of a fresh and unmitigated order block at the extreme. After a brief retracement, the price resumed its downward movement, forming multiple bearish breaks of structure and generating order blocks associated with them. As you can see, the price went back up and pushed toward the most recent unmitigated order block. It used this level as an inducement, triggering the stop loss of traders who had entered short trades from it. Instead of respecting this zone, the price surged above it, sweeping the liquidity associated with the stop losses of sellers. After filling the fair value gap above the order block, the price immediately entered its range. These actions provide a perfect opportunity for us to go short. In this scenario, we look to sell because there is no remaining buy-side liquidity, such as liquidity voids of a fair value gap or liquidity created by the stop losses of sellers left in the market. Now, if we look at the volume indicator, we can see it signals a bearish divergence. As the price continued its upward movement toward the point of interest, the volume bars started to get smaller and move in the opposite direction. So, we have the desired confirmation we were looking for. So, let's play out the chart and see what happens next. Now, as you can see, price was pushed lower, and after a tiny reaction to this demand area, flipped to the downside. So, we have a flip zone, which provides a perfect selling opportunity for us. Once again, if we look more closely at the volume indicator, we can see that a perfect spike has formed. This spike indicates a reduction in buying pressure, along with an increase in selling pressure, confirming that a bearish divergence is about to happen. With this confirmation, we're now authorized to enter the market by initiating a short position from this point. For executing my sell position, I'm going to set my sell limit order at the couple pip below the flip zone and set my stop loss spread size above the flip area. For the take profit, I am aiming for the sell side liquidity below this low, as I prefer not to keep my positions open for an extended period as the entry is executed in 1 hour time frame. Now that we have placed the sell limit order, let's see how the market reacts and see if our trade setup plays out successfully. As anticipated, the price activated the sell limit order, promptly moving lower and reaching the take profit level. In this episode, we've explored one volume trading strategy combined with smart money concepts. However, in the next episode, we'll delve into 2 more volume confirmation methods integrated with smart money concepts, which we couldn't cover today. Stay tuned for that. That's it, traders. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. We appreciate your support and look forward to seeing you in the next episode.